Hello and welcome to our first of many Fratarcangeli Friday market updates. We're going to be coming to you periodically throughout the month with Friday updates as to where we came from relative to data and markets, as well as what we're looking for in the coming weeks, and sort of an overview and then a call to action. So today we're going to talk about the last 2 weeks. We were in a situation where we had the S&P 500 up 5 straight weeks in a row prior to Memorial Day. That week ended with a north of a 2% decline in the markets, mainly driven by tariff news. We had the comments made by Trump entering into the long weekend, stating that the European Union wasn't working fast enough and well enough for him. So he was thinking about implementing a 50% tariff immediately starting on June 1st. By Tuesday morning's open, Trump had come out and pushed that back to July 9th due to communications with Europe that showed that they were willing and able and wanted to come to the table and get some action done on a trade deal. So that was led with the market taking off on Tuesday. In addition to that, we had some new orders for manufacturing for April showing a 6.3% decrease, which was better than the expected 7.8% decrease. That was on the heels of March's data, which was substantially stronger on the orders that came in prior to the tariffs being implemented. So the fact that the April numbers came in a little bit lighter was well received, and the market had a nice response on Tuesday. We're going to end the week strong, it appears. We'll see how today closes, but the market is definitely on an uptick. We had earnings come in. One of the biggest earnings reports that were anticipated and highly polarized was from NVIDIA. NVIDIA came out and beat the street by 3 cents a share. They came in at 96 cents as opposed to 93 cents. They also beat on the revenue side by roughly $700 billion. This is a very good number that caused NVIDIA and many other tech stocks to move higher on the news that came in after the market close on Wednesday. Furthermore, they talked about the fact that their data center increase year over year in revenues was roughly 70%. And this is big news out there in the tech world, as we feel that data centers are going to be the catalyst to enormous demand as well as revenue that's going to be generated due to the energy needed for this AI implementation in the coming years. Additionally, we have data that we're looking for next week. We have the job report coming out on Tuesday, and as well some job data that's going to be highly polarized on Friday. That'll be on June 3rd, as well as we're looking at the 6th of June. We'll be watching the data very closely. Overall, I would say the market is like a coil that is getting ready to expand quickly. I think the market has major upside, and one of the main reasons that I feel that way is I feel that the regulatory environment that has come upon us as the current administration is much more business friendly. And one of the things that we always watch closely is the amount of liquidity in the system, something called M2 supply. And the fact that there is liquidity in the system, even though they are taking out roughly $25 billion a month in Treasury, sort of sucking out some of that liquidity, which creates pause and concern with the liquidity factor. But the fact that the regulatory environment is going to allow banks and allow more of an opportunistic view for businesses to borrow and lend. And therefore, I think the monetary policy and the deregulatory environment is going to be a catalyst for upside. Furthermore, I think we're on the precipice of a major, what I refer to as the second chapter of this technological boom, driven by AI. We believe that this next chapter is going to be even more explosive. I don't think we can even fathom what's about to come and the impact that it's going to have on productivity and cost of doing business. More to come on that topic. But I would say the call to action today that we can learn from over this last several months is the market has been extremely volatile. We've had markets down as much as 20%, and then we had markets fully recover almost to the point where they're across the major indices positive for the year. But yet, when we were at the lowest points going back to April 7th of this current year, if you talk to folks about what they were doing, what they should have said is they're dollar cost averaging. They're putting money into the long-term allocations that were predetermined that they know they could sustain based on their liquidity needs and their ultimate objectives. And if they had stayed the course and stayed focused and unemotional, the outcomes would have been even more beneficial than the actual market performance. So we want to learn from this experience. We want to make sure that we stay stoic, we stay unemotional, we stick to the plan, and we stay educated on the current situation as well as the future situation. I look forward to talking to you more. I'll see you all soon, and we'll be back for a Friday market update within the next 2 weeks. Be well.